Hello again. In this last chapter of engineering economics class, we are going to learn about the depreciation methods. So in order to understand this concept of depreciation, we need to define it first, what depreciation means. However, before doing that, let's just show the outline of this lecture. We are just going to mention about 4 different depreciation methods which are commonly used in evaluating the depreciation amounts in the books of companies. These are called straight line method, declining balance method. There's a hybrid method of these two, which is called declining balance with switch over to straight line. And finally, the last methodology is called the sinking fund method. We are going to learn all of these depreciation techniques, each of which are helpful for us to determine the depreciation amounts of the inventory in company books. So in the end, we are just going to compare the calculations under each of these methods in a small section. So what depreciation is? Depreciation is a decrease in value of physical assets with the passage of time and use. So when you purchase a machine, and if you continuously use that machine for an amount of time, every year that machine that you own is going to lose some of its value. For example, let's just say you have purchased a turning machine to be used in your manufacturing processes. In every year of usage, the machine is going to depreciate, and its value, the worth of that machine, is going to decrease in each following year. Because of that reason, there is a concept that is called salvage value. For example, if you purchase a machine from $10,000 right now, and if you use it for 10 years, in the end of 10 years, when you want to sell this machine, it may not be possible for you to sell that machine from $10,000 again. So it is going to depreciate. Therefore, there will be a decrease in the value of this physical asset. So in other type of assets, sometimes we observe a price increase. For example, if you purchase an automobile, a brand new automobile, and if you use it for 2 years only, and if you intend to sell it in the end of 2 years, it is possible for you to sell that product, that automobile, from a higher price. But this is an exceptional case due to the economical conditions. Usually, every product, every machine, every equipment that we use depreciates over time. Okay. Now, here's the thing. Let's just say you have purchased a machine in this year. Okay, in this year, in the beginning of this year, you have purchased a machine to be used in your production processes, and you are just going to pay a huge amount of cost to purchase that machine. Okay, now in the end of the year, when you want to create calculations, cost calculation, when you want to perform cost calculations in your company's books, of course, it is not fair to write down this cost, the whole costs of that machine in the books, because this is just going to reduce your profit amount. Therefore, the tax that you are going to pay will be affected by that huge amount of cost. Remember now, the tax amount that the company is paying to the governments are calculated over the net profit in the company books in that year. However, if you write down the cost of that machine which you are going to be using for a long amount of time just in the books of that year, in that case, the net profit is going to be reduced so much. Therefore, the tax amount that you are going to be paying to the government is also going to be reduced. Now, if you are paying for a machine that you are going to use for 10 years, okay, if you are going to use that machine for 10 years, and if you are going to pay a cost for that, now that cost of that machine must be distributed over 10 years. Okay, we should not write down that cost in a single year. Instead, we need to distribute that cost as a depreciation amount to all of the years. In fact, the amount that you pay for the machine should not be written as a cost, because you are just converting your cash to the machine. Okay, so you are just giving cash to somebody and they are giving a machine to you. Therefore, this is not a cost. This is just a changeover between your cash and the machine itself. Okay, you are basically making a switch between the cash and the machine. Therefore, this is not a cost. This is just this cost of the machine, the amount that you are going to pay for this machine should be written on your balance, the company balance. However, it should not be written as a cost. Okay, so this is not a cost. However, if you are going to use that machine for a certain amount of time, every year that machine is going to depreciate and lose some of its value. Now, that depreciation is the cost that you need to write in your book. For example, if you purchase a machine from $10,000 and if you use it for 1 year, and in the end of 1 year, if you predict the salvage value of that machine or the second-hand value of that machine as $9,000, then this means in the last 1 year, this machine has depreciated for $1,000. Okay. Now, this amount, this depreciation amount, should be introduced as a cost in company books for that year, so it will be effective in calculating the net profit of that year. So you see, depreciation of the equipment, the loss of the value in the equipment that you have, in the machines, in the equipment that you have, they will establish an annual deduction against before tax income, such that the effect of time and the use of an asset's value can be reflected in a firm's financial statements. Okay. Now, if you are going to use this machine that you have purchased for 10 years, then this means its useful life will be 10 years. And over these 10 years, over this useful life, the value of the asset will depreciate. Okay. Now, in every year, it is going to depreciate for an amount of dj. Okay. So for its useful lifetime for n years, in every year, it will lose some of its value. It will depreciate at an amount of dj. And this is called the annual depreciation amount. And that depreciation amount can be different from year to year. Not every year the depreciation amount is just going to be constant. So the amount of the assets cost that is charged off in a given year J is called the annual depreciation. And there is another term that is called the accumulated depreciation. The accumulated depreciation is basically the total depreciated amount until the end of year K. So it is basically the sum of annual depreciations from the first year until the end of the K year, and it is represented by DK star. Okay, that is the accumulated depreciation amount of an equipment, and it is the total depreciation, annual depreciation from the first year until the end of the K year, called the accumulated depreciation. All right, so now that we have defined these concepts, we can define new concepts about depreciation calculations and depreciation methods. The first concept that we need to define is called the cost basis. Okay, the cost basis is basically the initial cost of acquiring an asset. So when you are purchasing a machine from $10,000, the cost basis of that machine will be $10,000. This is the initial cost of obtaining that asset. Okay, and you already know the definition of salvage value. Now, the salvage value is dependent on the year that you are going to sell the machine or remove that machine in your company's accounts. Okay, so that is the salvage value. It is either the second-hand price or it is something that you are going to get by recycling that machine So in what way you are going to dispose that machine is up to you. And depending on that disposal, there will be a return of that machine coming to your books. That is the estimated proceeds that will be realized from an asset sale or disposition when it is retired at the end of its depreciable life. So in the end of its useful life, in the end of n years, you are going to either sell that machine or dispose that machine, but in any way, it is going to return some value, not in the form of a cost, but in the form of a revenue. Therefore, salvage value will be a positive value, whereas the cost basis is negative, and it is denoted as SYN. Now, what is the net salvage value? Now, of course, there will be a salvage value by selling your second-hand machine in the end of n years. However, of course, you are going to remove that asset from your premises with a cost. For example, if you are going to dispose it, there will be some disposition cost as well. And by subtracting that cost of removal from the salvage value, you are going to get the net salvage value if there is still a positive revenue from there. But sometimes the cost of removal can be greater than the salvage value itself. Okay. Now the disposal, the amount that you are going to get as a revenue from the disposal can be the salvage value. However, in the disposal process, there may be costs of removal which are even larger than the salvage value itself. In that case, there will not be any net salvage value there. Okay. In that case, the net salvage value will be zero. If the cost of removal is greater than the salvage value itself, then the net salvage value will be zero. However, if the cost of removal is less than the salvage value itself, when you want to dispose that machine in the end of n years, then the difference will be calculated as the net salvage value. Now, by subtracting the net salvage value in the end of n years from the cost basis, which is the initial cost of acquiring an asset, you calculate the adjusted cost basis. Okay, so that is basically the cost basis of an asset minus the net salvage value. Now, we are going to use the adjusted cost basis in the calculation of the depreciation amounts. What is the book value? The book value is the worth of a depreciable property as shown on the accounting records of a company. Now you see, the book value of an asset can be reduced by the depreciation amounts in each in each year of useful life. So the book value is the worth of that equipment, worth of that machine, which is written in the balance accounts, okay, balance books. So now we are going to calculate the depreciation values using the straight line method. And straight line method is the easiest of depreciation calculation methods. So according to the straight line method, the annual depreciation of an asset is calculated by dividing its adjusted cost basis equally over its useful life. Now you see, we have learned how to calculate the adjusted cost basis. Okay. Remember, what is adjusted cost basis? From the cost basis, we subtract the net salvage value if it is positive, of course. Now, if you divide the adjusted cost basis to the number of years in the useful life, for every year you will be calculating the depreciation, annual depreciation amount. Okay, so in that sense, in the straight line method, the annual depreciation amounts are always equal to each other. They are constant in each following year. The accumulated depreciation at year K then will be K that times D. So until the end of year K, the total depreciation that is accumulated will be K times D, where D is the constant depreciation amount, annual depreciation amount. And the book value of the asset at year K, in the end of year K, will be the cost basis minus the accumulated depreciation amount, which is K times D. So in the end of year K, in the end of year K of the useful life of that machine, the book value of that machine will be calculated as cost basis minus the accumulated depreciation, K times T. So these calculations are very simple. Now let's practice these depreciation calculations. So why do we calculate these depreciation amounts? Remember, we need to subtract the depreciation amounts from our profit. So we will be calculating the net profit after depreciation amounts, from which you will be calculating the tax amounts to be paid to the government. So in the question, it says a new machine costs $160,000 and it has a useful life of 10 years and can be sold for $15,000 at the end of its useful life. It is expected that $5,000 will be spent to dismantle and remove the machine at the end of its useful life. So according to this initialization of this question, we can determine immediately that the cost basis of that machine is $160,000. This is the initial amount that you are going to pay for that machine. So its useful life is 10 years, and its salvage value in the end of year 10, the salvage value in the end of year 10 is $15,000, and the net salvage value will be the maximum of the salvage value minus the cost of disposition, which is $5,000. So for dismantling operation, you need to pay $5,000. So in the end, the net salvage value that you are going to get will be $10,000, since the cost of dismantling is less than the salvage value itself. So we have the net salvage value as $10,000. The cost basis is $160,000. When you subtract the net salvage value from the cost basis, you will get the adjusted cost basis. And since the useful life is 10 years, you need to divide the adjusted cost basis to 10 to calculate each year's depreciation amount, annual depreciation amount, which will be $50,000 for this question according to the straight line method. So this method is very easy. Now you see in this table, we are going to write down the annual depreciation amounts next to each year for 10 years, and the accumulated depreciation will also be calculated. So right now you are purchasing a machine that is worth $160,000. So you have a machine right now which is worth $160,000 in your books, in your company books. However, that machine is going to depreciate by $15,000 in the end of first year. Now in your company's books, the worth of that equipment, the worth of that machine will be reduced to $145,000. Now that annual depreciation will be written to your costs in the end of the year, and by deducing that cost from your profit, you will be calculating the net profit to calculate the tax amount. Okay. Now, in the next year, it is also going to depreciate by $15,000 according to our calculations. So in the end of second year, the worth of that machine will be $130,000. So by a constant amount, it is going to depreciate in each following year. In the end of 10 years, the estimated book value of that machine will be $10,000. Okay. So this is how the equipment is going to depreciate for years and years and years. Okay. Now, there is another method that is called the declining balance method, but we are going to explain this in another video.